We've had 40 years of money being freely available, of no real restrictions on exchange rates in the developed world to move. The result of all that has been a whole series of asset bubbles and a huge expansion of debt relative to GDP. It's very hard to see how that's sustainable, how to put the genie back in the bottle. One answer would be to have capital controls. Capital control is a way of monitoring the flow of money in and out of the economy.
We have border controls at the airport, for example. When people come in, we check their passports. Capital controls would be a way to do the same thing for money.
For the past 35 years, the world's largest financial institutions and most Western governments have worked to strip away all obstacles to the free flow of money from country to country. The idea is simple. The freer the money, the more prosperous we all become. But is free-flowing money really the panacea we'd all hoped?
A country has to care about what kind of money comes in. So just like you wouldn't want to let a terrorist into your country as a person, you might not want financial terrorists to come into your country and decimate your economy with their activities.
The short-term objectives of investors are often conflicting with the objectives of a country. The problem with short-term capital is that it seeks the highest return possible.
That money can go out as fast as it can come in. So the danger is you get these sort of hothouse effects as the money goes into the economy, driving up your exchange rate, driving up property prices, and then you kind of get a nasty out the plug hole effect as they take it out. Suddenly property prices crash, your banks crash, your currency crashes, and you get this awful mess that results. Some economists believe that capital controls are harmful because they are an artificial restraint on the market. Capital should flow to where the best investment opportunities occur. The trouble with letting capital flow freely is that investors aren't always completely rational, or rather one might say that they elevate short-term profits over long-term profits.
Neoliberalism has come to dominate economic policy in the modern world. As the wisdom goes, removing restrictions on the flow of capital will ensure that investment naturally makes its way from rich countries to poorer ones. But this doesn't seem to be happening.
The theories which predict that you might have some costs from regulating capital flows actually don't bear any relation to reality as we experience it. It's not just about money and where it's moving, because when a financial crisis happens, it creates unemployment. It reduces, people's livelihoods and security in their jobs.
Financial crises in developing countries have devastating impacts. For example, looking at the impact of the Argentinian financial crisis, nearly 60% of people by sort of the end of the crisis had fallen below the poverty line. 75% of children were living below the poverty line, unemployment had doubled, income inequality had widened.
And so it creates societies which are less well, they have less well-being, and people are less happy out of it.
Classic example perhaps was Thailand in the 1990s. They had this huge bubble and boom as money flowed into the economy. It all went into building new office blocks and other speculative property investments. And then all the money went out again. So it was as if you'd had this massive storm which went all through the sewers at one moment. A lot of stuff flowed out of the sewers as a result, not all of which smelling very pleasant. And Thailand went through a very deep recession after they were forced to devalue their currency in the late 1990s.
Most of us would agree that developing countries must seek investment from developed ones in order to grow. But some kinds of investment are better than others.
What you want is long-term money, money that builds factories, money that goes into employing people in the economy in long-term jobs, because then that money will stay.
And I think the evidence has been that countries that have done this, they haven't experienced any drop in the kind of investment that they would want. On the contrary, actually, as you put in these kind of regulations, you make your economy more stable, you make things more predictable, you make your exchange rate more stable, and then investors actually have a better prospect for investing for the long term.
While emerging markets are naturally most at risk, it now seems that even more stable economies are not completely safe, from bubbles that will one day burst.
We've had a recent example of something similar in Iceland, where Iceland had this very high interest rates, very strong currency, caused a speculative boom, and of course then everything collapsed, and Iceland now has capital controls to protect it.
Other developed markets are also finding themselves hamstrung by existing liberal policies.
A country such as Greece, which has seen huge levels of capital flight recently, is unable to impose capital controls to try to limit that.
It's written into the Lisbon Treaty. It's not even a regulation. It's the constitution of Europe, if you will, that you have to have free movement of capital. And not only do you have to have it within Europe, but you're supposed to demand it of all your trading partners as well.
The current financial crisis has started in the United States and has impacted many countries in the world through a contagion effect. So it is important to actually consider that countries cannot just look at domestic regulation, but it's important to really reconsider the international regulations.
We should also remember that this is not the way it always is. This is not the natural state of affairs. In the past, we actually had quite strict rules about where money could move and how. Originally, back in 1945, the IMF actually believed very strongly in using capital controls, and they believed that for the first 30 years of their existence.
The problem was that as the last century drew to a close, there was a lot of pressure from the West for developing nations to open up their economies. Now, the argument was that this would facilitate private investment in these countries, it would facilitate the flow of capital from rich countries to poor countries. But of course, one has to keep in mind that this was also serving the interests of investors. Brazil, for example, has implemented a financial transaction tax, otherwise known as a Robin Hood tax, and this is explicitly to try to penalise and thus reduce speculation. Other examples include countries like China, which has enjoyed extraordinary levels of growth recently. China has strict limitations on what non-residents can invest in with regards to shares and bonds. And then you've got countries like India, which effectively ban foreign investment in Indian banks. Joseph Stiglitz, who's a Nobel Prize-winning economist and the former chief economist at the World Bank, did lots of studies into the Asian financial crisis, and he found that countries that implemented capital controls, so for example Malaysia, had much shorter and much shallower downturns than countries that didn't.
Financiers do find their way around capital controls, and it is a problem facing particularly modern economists in devising a way to control capital.
Money is a bit like a river. It can flow around the obstacles that get put in its place. But the point is, we can try also to channel the water. There's lots of ways that we've designed systems to manage the risks. You need to think about creating some limits and boundaries within which the water can flow as it sees fit. I'm definitely optimistic about the prospects for controlling international financial flows. And the reason is that the countries which are becoming more powerful and richer in our international system understand that completely unfettered markets and completely unregulated flows of money are risky and dangerous.
The US and the UK at the moment are desperately trying to stimulate their economies, and one of the ways that they've been doing this is through something called quantitative easing, which many people would describe as printing money. Now, as countries like the US have announced these schemes, countries like China have shouted out and protested, basically saying, well, this money isn't actually staying in the US, it's going straight out of the US, it's being invested in things like commodities and emerging markets like China. So they're essentially saying, you're not helping the US economy and you're just causing the Chinese economy to overheat.
Huge global economic imbalances also arise from the sheer size of the US budget and trade deficits, which the Chinese government is funding by having a seemingly limitless appetite for buying and holding US government debt.
It doesn't sound like a good deal for the Chinese in the long run. And basically, the Americans are getting goods and the Chinese accumulating little bits of paper on which they know the Americans will renege. So if we get a system whereby the huge economic imbalances are not as destabilizing as they turned out to be in the last 10 years, then that will be good news for the global economy. But it's not the sort of agreement that gets hammered out overnight. It's going to emerge over 5 or 10 years.